Okay. Hey, by the way, it was a great article. Okay. Well, let's start. Okay.
Yeah, yeah.
And
All right, all right.
so, hey, this is Greg McIntyre with the Elder Law Report, and we're going to talk today about heading toward a tax-free retirement with long-term care insurance. It was a really, really awesome concept. You know, we've been exploring tax-free retirement. Brenton wrote this article that we're going to talk about today. Brenton is an attorney in our office, an associate in our office, who has an LLM in tax. So that's like a legal master's degree, kind of one above or, in addition to a law degree that focuses just on tax. I think that it deals with a big problem we have in protecting assets. It really strikes the heart of a lot of the clients that we have and positions people find themselves in retirement. So, Brenton, take it away.
Yeah, a big problem that people experience, and I've noticed that people experience when they walk through the door, is that they've worked hard all their lives to earn a decent retirement, but then they get picked apart by taxes when they want to live their best life. Not have to work, not have to worry about financial situation, and just take care of themselves and live out the rest of their life in relative ease, and not having to worry about planning to pay their taxes at the end of the year, or planning to work through a tax problem when trying to make a decision, right? So another thing that we encounter a lot, and as you can attest to, is the fact that, hey, 70% of individuals over the age of 65 need some type of long-term care, right? So you got this issue with taxes, you got this issue with long-term care, and what I was thinking is, okay, we got these two issues. Wouldn't it be nice if we could solve both of these problems in one fell swoop? So in my research, and we've done a lot of work with long-term care insurance. We suggest long-term care insurance to individuals who can qualify for it. Even if you don't think you can qualify for it, you should at least look into it, because it's a big deal. The cost of care in a facility, whether it's assisted living, in-home care, or nursing home care, is going to be astronomical. And what you pay in premiums for long-term care is, not even half of what you're going to pay in a month at a facility, right? So long-term care insurance, it's great, and we've had a lot of good experience with that. So when I was looking into some long-term care insurance products, you have these companies that carry different products. I came across what's called an asset-based product. So an asset-based product is essentially, instead of paying just premiums out of your pocket like you would with a regular insurance policy, like your life insurance policy, car insurance, like you're used to, you kind of do it from an asset that you already own, right? So what that looks like is you have let's say a 401k, right? And there's two types of 401k. Either you can have a Roth or you can have a traditional. Now there's a third type called the SEP. Let's not get into that. We're just talking about the traditional or the Roth, okay? So with the traditional, you could build up quite a bit of money in there because it's pre-taxed. The money has not been taxed, so it's a higher amount. So it builds more compounding interest. So that's a good part of it. But the bad part of it is once you retire, guess what? You got to pay the tax on that money when you pull it out, or you got to take minimum required distributions, and that can be pretty arduous. That can bump you up into another tax bracket, and create all sorts of problems. So the issue that you kind of face there when you're retiring is, okay, how do I pay for long-term care, and how do I mitigate the tax on this retirement? So with the asset-based long-term care policy, you can use your asset, your IRA, that pre-tax, what we call qualified funds, to pay for long-term care insurance. And it's essentially a rollover. You roll it over from the IRA into the long-term care plan, and you defer that tax. You further defer that tax, and which is a big deal. Obviously, depending on the amount of Social Security you're getting, depending on your income, that tax deferment can mitigate your tax bill quite a bit. And depending on the cost of your unreimbursed medical expenses for that year, you may be able to deduct the amount you pay in premiums for long-term care insurance. So there's lots of benefits to be had there.
To count off.
There's lots of benefits to be had.
To count off against the tax.
Yeah,
Against
exactly.
the tax from pulling that out of a qualified asset, which is phenomenal.
Right.
Which could end up being tax-free use of that money. And, dude, I mean, long-term care insurance is a godsend for people if they can put it in place, because it can save everything, the real estate, the rest of the retirement, and just people are sold on this concept. And it's not a bad concept. I don't mean to demean the concept, but they're sold on this concept that, hey, hand over your money to Wall Street at an early age. Do it early and often. Trust us. We're going to manage it. We're going to grow it for you. And the government has created these things like IRAs, 401ks, qualified annuities, qualified funds that are pre-tax. So you can grow more money because you're dealing with a larger amount of money because it's pre-tax. It's before you pay taxes, before you pay employment tax, FICA, those things, Social Security, those things. So it's a bigger pool of money to work with, but what really, really stings is when you start pulling that out and getting taxed on it, and you have to figure out a strategy to maximize those funds and that money. And then, then you got to pay the price. So they're going to, the government's going to collect their taxes no matter what your plan is, but there's ways like this to use asset-based plans, right? To not only defer the taxes immediately, but also pay for long-term care. But over time, as you pay for that care or that insurance, right, that's going to pay for care, to when you have to use the deductions, it could count off because of what you're paying for care could count off on the money that's coming out of that qualified plan.
Right. So there's a couple things there. When it comes to retirement, obviously some is better than none, right? But like you said, there's a conception there that a 401k letting Wall Street grow your money and letting the government, produce the vehicle that grows the money is going to be your best
in New York City, because don't trust anybody.
Right.
All New York City, it's going to be fine. Trust us.
Yeah, exactly. And the obviously the issue with that is the fact that it's short-sighted, really. One of the biggest things that's short-sighted about is paying for long-term care. You go to any number of seminars, any number of educational lunches, dinners, whatever, about finances, about retirement, and you don't hear much about long-term care. And if you do, they glaze over it. It's a big issue. Like we say, like that 70%, that's a big deal. If I was playing the odds in Vegas, 70%, I might not lay down I might not ante up. You know what I'm saying?
Are you going to bet on something you have a 70% chance to lose on?
Yeah.
Like a 70% chance that you'll need long-term care, in-home assisted living or nursing home care? No, that would be stupid of me to lay money down where I know I've got a 70% chance to lose. No, I want to put money down on the one I have a 70% chance to win on.
Right. Exactly. And, I recently came across a statistic that was basically, if you have a regular couple, like a normal couple without too many underlying health issues, they're expected to pay from when they retire to when they pass away, $300,000 in medical expenses, and that's not counting long-term care. That's aside from long-term care. So a couple things there. First of all, your 401k, your other qualified accounts are short-sighted in that respect. They don't even pay attention to that, much less long-term care. Second of all, medical expenses are going to be a reality. And so the fact that you can deduct what you pay for those medical expenses is a huge deal. And so sometimes you have medical expenses and you're not quite there. You don't quite meet the threshold where you can deduct anything from your taxes, And if you're looking at it from a planning perspective, if you start paying for long-term care, which the cost is like we said, negligible compared to the actual, with long-term care insurance premiums compared to actual long-term care. If you start paying for that, that can kind of bump you up in that next little bit, so you can start deducting all of that cost of medical expenses that you're paying out that are not reimbursed to you by some type of insurance. So it's a great planning tool, because essentially you're going to be paying medical expenses anyway. You might as well take advantage of that deduction by planning to use long-term care insurance in this way.
Agreed. And I just don't think there's enough information put out about what you're suggesting and about planning for a tax-free retirement, but also having long-term care insurance to protect the majority of your assets. So,
right.
Which to me is more of is more of a legal planning tool than an insurance planning tool.
Oh, right? Absolutely. And I think that's the best way to look at it.
And here's why I say that is because people don't understand that they can't place the IRAs and 401ks inside of a casing of a trust, like an irrevocable trust, to protect it from a spin down or Medicaid recovery or to still use it or to save it for future generations. It's totally exposed. It's totally exposed and unprotected in that pre-tax form. You can't do anything with it. So, except for things like this, which is use it in a positive way, use a small part of it to protect the whole with long-term care insurance, with an asset-based plan.
Right. And here's the thing, if you're just planning to say, okay, I'll pay for my long-term care out of my retirement account until I get to the point where I need Medicaid, and I'll have Medicaid pay for it. Now, Medicaid can be an option for a lot of people, and hey,
but it doesn't have to be. In this situation, I mean, you get premium of everything and protect the majority of your assets, and use a small portion, which was set aside to pay for the long-term care insurance, pre-tax. Right. Use that to provide premium service for you in a home. I mean, it can be in a home, right? Who wants to go to a nursing home? I don't.
Right, exactly. And the thing is too is that you have a lot of people out there who are concerned about paying the premiums. First of all, paying a monthly premium, having that monthly obligation. An asset-based plan is going to take it from the asset, right? So it's a way to kind of not have that monthly obligation for what you've already budgeted. So that's one thing. And the fact that just like any other insurance, in some people's mind, it seems like a gamble. Even though we present all day that, hey, 70% chance that you need long-term care, some people still think, what if I pay and I don't need it, right? Just like car insurance, what if I pay and I don't need it? Well, first of all, if you get in a wreck, you better hope you have insurance. But the thing is too is that with long-term care insurance, there's a variety of plans that you can get. One of the ones that I like that you can get with an asset-based plan is a chronic care rider. And what that is essentially, if you have some type of illness, right, that's not quite the level of long-term care, you don't quite need long-term care, but it's beyond what your Medicare is going to pay for, and it's beyond really what you can pay for out of your own pocket. You can get your long-term care insurance policy to kick in to cover that cost of care, which can also be, something that you don't have, debt that you don't have saddle your estate, that debt that you don't have your spouse inherit. Because guess what? In North Carolina and in some other states, your spouse is personally liable for all your medical debt,
Is that the doctrine or rule of necessaries? Is that what it is?
Necessary.
Yeah, necessaries.
Right.
So, yeah, where you can be liable for your spouse's medical debt.
That's right.
So, well, hey, there's a lot of stuff here. We could talk about this for a long time. Just for the sake of compacting it down to an episode, I'm going to wrap it up. We're going to wrap it up. But if you have any questions out there about how to plan for a tax-free retirement with long-term care insurance, and also other legal questions regarding getting your affairs in order, protecting assets, making sure you're ready for what may come, give us a call, 704-259-7040. We have multiple offices in your location where we can help, I'm sure, and we'd be glad to help. And thank you so much, Brenton, for being on the Elder Law Report today. I hope to see more of you on the Elder Law Report. And great article. Thank you. You have a great day, okay?
Please don't wait.